Hello, everyone. It's Bill Fairman, Wendy Sweet, Jonathan Davis. This is another broadcast of the Carolina Capital Management in the middle of the day show.
It's called the Ask an Ugly Question session.
Our version
That's
of a soap
easy.
opera in the middle of the day.
That's right. That's
Excellent.
right.
So, if please make sure to like, share, and subscribe to our show. If you want any information on us, it's carolinahardmoney.com. If you're a borrower, click on the borrower tab. If you're interested in passive returns through investment, then click on the investor tab. So
Yeah,
I made it through that.
You did, and you know, Jonathan and I are making the screen exciting. We're doing the great faux pas of video, and that's to wear something busy.
That's right. Yeah.
When you're being recorded, right? So
Solid colors.
That's right. Solid guy, solid colors. We're just busy kind of folks.
So I've changed some of my lifestyle. I'm drinking a lot of water.
He's one of those people. Not the drinking the water, it's carrying the jug around everywhere.
You called him a gym rat this
It's
morning
like,
now, right?
Oh, man.
He's a rat.
They won't even let you into Planet Fitness with a jug that big.
Really?
Yeah. They're like,
Won't
no
fit
gym.
through the door?
Yeah. Well, no, there's just no gym rats here. They see the jug. It's like if you have a jug of water or one of those like skinny teas.
Well, wait a minute. I thought that was the what did they call them? The judgment-free zone.
I know, but they judge those before you get in, I guess. I don't know.
It's the judgments of judgment-free zone.
Judgment free once you get inside.
Yeah. What do they call it? A lunk. They say, yeah, no lunks allowed. And if you carry a jug or you wear those skinny little, do you wear those skinny little cutoff shirts?
No.
He's here to pump you up.
I don't have the body for that yet.
That remind you of Hans and Franz.
Notice how I put yet.
Yeah, that's good. Goals.
He's working hard, and I'm proud of him. For an old guy, you're in great shape.
Well, thank you for that backhanded compliment. However, I did get my first senior discount at Publix.
Woohoo!
Nice.
Did they ask you for it, or you just?
Yeah, unfortunately, she said, "Are you a senior?" I said, "Well, that depends on what your senior threshold is."
Wow.
Oh, that's got to make you feel good about yourself, right?
Yeah. What was worse is I had a mask on. They really couldn't
Man,
see.
she saw it. She saw through the mask.
She
Wow.
saw it in your eyes.
Whew.
The old in your eyes is
Yeah,
what.
she saw the bags under my eyes. And
Maybe you could just tell yourself, she just assumed because of the mask, she just wanted to ask. If she would have saw your face, she would have known that you weren't a senior.
That's right.
Yeah.
You should have said no. Are you pregnant?
good try. I'm trying to stay. Well, I want to keep all my limbs. I'd have probably been beaten with something.
I say that because he did ask somebody when she was due and she wasn't pregnant. That was a great spot. But anyway, we're here for stuff about real estate.
That's one of life's learning experiences.
That's right.
No matter how far along you are, I'm never asking.
That's right. Yeah, you learned on that.
All right,
one
so
for sure.
let's start off with a different ugly question.
Yeah.
Like, are you expecting?
It's only ugly if the answer is no. Too funny. Okay, so our first question is, why do national hard money lenders and private money lenders all seem to have the same or similar boxes or guidelines that we all deal from? And that's really a great question because they are pretty much the same, right?
Yeah, I mean, when you look at it, you're going to see slight variances in LTVs as loan to value, LTCs loan to cost, slight rate variances, stuff like that. But on the face of it, they all pretty much look the same. And why? Like, is there a national convention where we all meet and and say this is what we're going to lend and this is how much we're going to charge? No, actually, the hard money private lending space is one of the most fractionalized spaces there is. And why do they look the same? It's because they're using someone else's money.
Right.
And they're using someone else's money to fund the deals. So someone else is making the determination on what that deal needs to look like, so they'll buy it.
That's right.
Yeah.
That's right. I mean, that's a great, when we came up with what we lend out on, we base it on whether or not it's a good deal for the investor.
Yeah.
And that's what so many people find really hard to understand. That's what the investor sometimes finds hard to understand, that if a hard money lender doesn't want to do your loan at a higher loan to value or in a certain area, whatever the reason is, it's because they're trying to abate their risk, right?
Yeah.
So that should be the investor's concern as well.
Yeah.
Because you're the one that's taking a bigger risk than the lender, right?
In a lot of circumstances, yes. I mean, when and to get deeper into this question, before 4 months ago, there was a lot of Wall Street money
That's right.
backing a lot of these, and I'll use air quotes when I do this. I don't use them often. Hard money lenders who were just really originators. And they didn't have any money. They don't have a balance sheet. They don't have a fund that they lend out of. They were originating for
or brokering.
In other words. Yeah, basically, we have what's called a white label. So they would take the lender's docs or the Wall Street money's docs, and they'd put their name on it, close the loan, and then the Wall Street money would buy it, or the fund or whomever it was would buy it, and it was on their docs already, and they would just assign it over. So why do they all look the same? Because you're lending, or you're working with money that is trying to lend nationwide,
right?
And to do we all know this as investors. Every market is different. Every region is different. Every city is different.
Right.
Neighborhoods, streets, we know that they're all different. And there's really no way to underwrite to those differences. So you have to create a box that says, okay, if it hits inside this box, no matter where it is in the nation, we'll take it.
That's right.
And that's why they look the same, because it's the same, risk adjusted kind of box that they create that says, whether we're buying in California or we're buying in Alabama, if it hits this, we'll take it.
Right.
So a deal in Alabama isn't the same deal in California.
Right.
They're going to look differently. So it doesn't allow that flexibility, but it does hopefully mitigate risk, is what they're hoping for.
That's right. And that's one of the reasons why we are very particular about the area that we lend in. We lend in North and South Carolina and the states that touch us, and a couple more outside of that range, but all right here in the Southeast, because we understand how the Southeast works. We understand that market. We're really similar with how we lend in this area. If we were going to, even just going across the border from somewhere in the Southeast, let's say Virginia, even Northern Virginia can get quite a bit different from what we do here. But once you cross that line and you go over into Maryland or New Jersey, or, God forbid, New York, it's a completely different lending world.
For sure.
And you would want your criteria to be different. That's why we don't go over there.
Yeah. I mean, you even take Charlotte, for example. I mean, would you lend on the same guidelines in Dilworth as you would in, Northwest Charlotte?
Right.
Probably not.
Right.
Like they're very different, and that's in the same city. So you you have to be able to have that flexibility. And that's where, I'll go ahead and toot our horn here. We have that flexibility to say, okay, that's a deal here. I know it doesn't fit what normally we do over on this side,
right,
but over here, that's a deal.
Right.
And most originators, or you put brokers, they can't do that because they don't have their own money. They're beholden to somebody else's terms.
That's right. And the product matters, not only where it's located, but what is the after repaired value? What's the price point that it's going to sell in? Mm-hmm. We're much more happy to lend on a house where the after repaired value is under $400,000.
Oh, for sure.
Than we are for one over, because we know that it's going to take longer to sell. So, mm-hmm. if we are lending something a little higher than that, we might charge more for it. We might do a lower loan to value on it.
Yep.
That's how we can change like that. So So the reason why, like Jonathan said, that they all seem to be similar is because they all seem to be pulling from the same money. One of the things I wanted you to get a little bit deeper in, Jonathan, is you talked about loan to value and loan to cost.
Mhm.
A lot of people don't understand, why do we care about loan to cost?
Mhm.
What really is the loan to value, loan to cost, and ARV? Because they're all kind of connected, but they're not really.
Yeah. So loan to cost, loan to value, and after repaired value or subject to value. Subject to value ARV is simply that. What is the value of the property once all the work is done? So we lend on those values. Now those values are not set in stone. I mean, Bill and I had these conversations all the time. I mean, appraisers are using historical data, old data, to take a property in its current condition and forecast a new condition in the future, and what's that going to be worth. So typically when they do ARV values, they're going to be conservative because they don't know what the market conditions are going to do. So you'll see people, or I see people come in like, the ARV in this house should be like 220, and then it'll come back 190 or 195. And that's pretty typical. I mean, if you can get 220, that's great. But the appraiser giving so many different conditions that have to happen in the future is probably not going to be as bullish on the value as an investor is.
Right.
So that's ARV or subject to. Your loan to value. We care about that, not only the end loan to value, we care about the current loan to value when you buy it. So when we do a loan, we want to manage the lenders, our exposure on the loan based on a loan to value. So at the start, what is it? At draw 1, what is it? 2, 3, 4, and then at completion, what is our loan to value? And we like to be, definitely below 70, but our kind of sweet spot right now is 65%. So we want to make sure that we are at or below 65% loan to value over the course of that property, no matter where it is in the process. So then on loan to cost, we typically lend 90% of the purchase price. And we'll lend 100% of the rehab. So on the purchase, we're lending 90% loan to cost. On the rehab, we're lending 100%. So depending on the rehab size and the purchase price, it'll be somewhere between 90 and 99% is going to be the loan to cost. We lend more than most anyone else. You're going to see everyone else is going to be lending between 80 and 90% loan to cost, which means that you either have to bring 20% down on the purchase, or you have to fund your own rehab account or some portion of your rehab account. And why is loan to cost important? So that the lender knows that you have skin in the game,
right? So
that you are invested in the project and its completion. If you have zero money in it, then from the lender's perspective, you're probably not as concerned if something happens and you could walk away and the lender's left with a project. If you have some money in it, you stand to lose something. So the lender says, okay, well, if they stand to lose something, they're probably going to be a little more motivated.
Right.
Yeah.
And loan to cost is important to you as an investor as well, because you don't want to be too deep into a deal, for it to be a deal.
Yeah.
It's important to use the numbers that whatever lender you're working with, whatever private money you're working with, it's important to use their numbers to your benefit, their guidelines to your benefit, so that you can calculate the deal and see what works. And if you just don't believe what they're telling you and you want to get that loan done anyway, did you want to talk?
Bill's being unusually
I've
quiet.
never heard him. That's because he raises money. We put it out on the street.
So when you're finished.
But when now I totally lost my train of thought now.
Sorry.
Jump on in, Bill.
What did you want to say?
So one of the benefits of institutional money coming into our space is that it brought the rates down for everyone.
Yes, it did.
Well,
That wasn't beneficial to us.
well, I was
but-
going to say, like, well,
Let me finish. It's still beneficial to other lenders that are balance sheet lenders like us,
right.
because when you're a balance sheet lender, just like a private lender, sometimes you run out of capital,
Yeah.
and you need the institutional investors out there to deploy capital in
Mhm.
order for you to recapitalize so you can continue to make loans. If you run into that issue where as a fund manager, your biggest fear is two biggest fears. One is I don't have enough money to make loans with.
mhm.
The second biggest fear is I've got too much money and it's dragging down my yield.
Well,
Yeah.
but
It's one or the other.
what you're saying is assuming that whatever these people are underwriting guidelines to would fit the box
Right.
of the people who are purchasing it, and that's not necessarily the case all
Well,
the time.
no, I get that. And I
Yeah.
said the benefit is that they've lowered the cost for the borrowers because they brought rates down. And the reason they have a box, obviously, is because they're lending nationally, but they also have investors,
Mhm.
and they have to have parameters. Most of the institutional investors that have money in our space are not publicly traded. They are hedge funds, and they're just using accredited investors like
Right.
everybody else.
Right.
Yes,
They
some
have
of them-
documents that say this is what we're going after, and this is how we're going to mitigate risk.
Right.
It's all in the document. So
Mhm.
they have to come up with guidelines that fit what the PPM say.
Right. Just
Right.
like we did.
Yeah.
Mhm.
So what? Now we're a local lender. We're a balance sheet lender. We look at the total risk picture.
Mhm.
It's not in a box, but it's going to be in some sort of a box because we know what the vast majority of the risk factors are.
Right.
And then we try to offset issues that might hurt it by capitalizing on the issues that are over and above what we need.
Right.
Okay, so we're taking the weaknesses and the positives and we're putting together and coming up with our own risk. That said, because we are big enough and we have the capital to do it, if we do need to sell off pieces of the portfolio to raise more capital, we can always mitigate what those institutional investors don't like about what we're selling them by holding on to a piece of the loan, and now their risk
guaranteeing
is less
performance,
Yeah.
basically.
because
Yeah.
we're still in it too. We have skin in the game,
Yeah.
so to speak,
Yeah.
Yeah.
on the loans we're selling them.
I'm gonna-
So your brokers or your originators can't do that because they don't have the money.
They don't have the
That's
funds.
right.
Yep.
to
That's
put
right.
into the deals.
Well, I'm going to jump on my soapbox here because you brought up the rates. So, what a combination of these hedge funds or Wall Street money or whatever you want to call it coming into the space, coupled with HGTV,
Mhm.
has done is
So true.
is open up capital to first-time new investors, which is not a bad thing. That's a good thing.
Mhm.
But what it's also doing is you're seeing these rate compressions, and you are now targeting and going after transactional borrowers, people who only care about the rate,
Right.
not relationship borrowers.
Mhm. Mhm.
So when you do that, you are only going to target new investors or new borrowers, first time flippers, and they're typically a higher risk level because they don't have any experience.
Right.
And the originators who are doing this don't have an education program to help them through. So they're relying on their Uncle Steve to help them come over and do some rehab work.
That's right.
Then you have the other side where you have someone who does 50 plus flips a year. And that becomes, attractive to them. Like, ooh, a lower rate, I can do that.
Mhm.
And I can save some money doing this. And then they butt up against whatever the criteria or threshold is for the maximum loan amount to a single borrower. So then they hit that. So those are your two extremes, and that's who you're really lending to, are those two extremes. It's the people who do 2 to 30 flips a year. that are left out of that, because those are the people who are attracted to relationship
Right.
lending.
Right.
And that's where people like us
That's
come
our
in.
sweet spot.
That's our sweet spot. Like they have the experience, but they're not a full machine.
Right.
But those people are left out. Now, do they like a lower rate? Sure. But they're buying enough deals and have enough experience that their margins allow for them to pay more for a better product.
That's true.
The person who has one, they don't, I mean, you probably talk margin with them. They might not even know what margin is. So, they don't know. They might have razor thin margins. And same thing for the guy who's doing 50 plus. He has a crew, he has a team, he has like their margins are super thin. So those are the people who are attractive. So when that's your portfolio is comprised of those people. I don't worry, too much about the 50 plus guy. He's going to get annoyed because he's going to hit his threshold.
Yeah, and he's got his own private money people,
and he's got his own
he might
private
have
money
banks
people
that are lending to him.
But then those portfolios are comprised of mostly first time flippers.
Mm-hmm.
So if something happens, out of the ordinary, I don't know, let's say COVID-19, then you have a portfolio that's stressed because of an event, and your portfolio is comprised of first time unexperienced flippers.
Mm-hmm.
How will your portfolio fare when it's stressed?
That's right.
I wonder why all those hedge funds stopped buying.
Yeah, exactly. That's a great point. Well said, Jonathan. I'm glad we got that on tape. The other thing too, you mentioned this morning that you've probably gotten a half dozen emails from other large hard money companies that are now back up to a 70% loan to value.
Yeah.
At
least that's what they're advertising. I don't know.
Yeah. And what score do you have to have that? So they do. I mean, I've seen some people, I've gotten 2 emails saying that, but your scores are going to have to be like 720 plus, 780 plus. I saw on one, to get up that high. But, my first reaction is, it might be a little too soon to get comfortable with what the values are on properties right now. We're approaching an election. We are just now to the point where people aren't getting all the free money that they've been getting up until recently. And, it takes about 3 months for a house to really fall into the pre-foreclosure process. And, I don't know. I'm just feeling a little queasy about people being in deals a little deeper.
Well, the equity's still in the homes. So
at this point. Yeah.
So are people tapping into HELOCs to cover that gap? I don't know. I mean, Bill, have you looked at that?
I haven't seen any data on the number of HELOCs. I know that there were certain banks, I believe it was Chase and Citi, that were putting a hold on all their HELOCs because they didn't want what happened during the
everyone to max it out and then completely eat away the equity. Yeah.
By the way, if you guys have any questions, there's a chat box either at the top or at the bottom, depending on the platform you're on. Just add in a question and we'll be happy to answer it. But there is plenty of equity, and there could be people that are utilizing that to pay their bills.
Yeah.
But I think the banks are going to have a little bit more. They're going to have tighter reins on them this time around.
I hope so. A lot of people forget. I'm always surprised at the number of investors that do really, really well that seem to have forgotten.
Yeah, they get amnesia.
The recession in 07, 07, 08, 09.
Are those probably the same investors who don't understand perhaps market cycles? Like real estate's pretty.
It's cyclical.
Pretty predictable. I mean, give or take a few years, you can pretty much, you can't say like this is the exact moment that something's going to happen, but you can get within a 2 or 3 year span and say, hey, in this period, I mean, we're probably looking for a recession.
That's right. Yeah. That's right.
Now, keep in mind, interest rate. How long have interest rates been low?
mean,
it's
12
been
years.
I mean, quite some time. I mean, they've been under what?
They haven't been like they are now for 12 years. They've been low like
They've
this
been
for
still under
a
5.
couple.
I was going to say under 5 since what? I would say under 5 since
Maybe 3 years.
I would say, well, I was going to say 2017, 16, 17.
I'm thinking more like 12.
You would think it was
2012?
under?
No,
Was it
not
under
quite.
in 12?
Anybody can answer that question for us?
Somebody
That would
Google
be-
that for us, will you?
Yeah. Is man a creation of God?
Of course. That was an easy question. All right. So that said, what my point is, they may not have amnesia. They might just not have been around or paying attention during the last.
Yeah, and I think
And they,
yeah,
when they got into business, it's just been full bore ever since.
Yeah.
Well, I mean, and anyone who's under 35 wouldn't have been an investor during that time.
That's right.
So,
And
I mean,
apparently they didn't teach it in school, the history.
I would say
It
the
gets changed.
vast majority of people who were in college at that time didn't know there was a recession.
Yeah,
going
they
on.
didn't really get
until
it
they,
all.
until they got out to get a job.
Yeah,
Yeah.
well, and even and they didn't. I mean, you saw that was during the time where continuing education was going on. People were staying in school, taking debt to do master's degree, law degrees, stuff like that.
Yeah.
Yeah.
So let's talk a little bit about what we're really seeing, like on average across the country. LTVs we're seeing right now for fix and flip, we're seeing 60 to 70%.
Yep.
We're on rates. We're seeing. I think I've seen a 9 come through, a 9.99 come through.
I've seen 9s on flips, and I mean, I see again
And 12, 13, 14. I've seen those
Mhm.
hit too.
Yeah, on points, I've seen it as low as 2 points and as high as 5 or 6 points.
Right.
Which those are a little more
Cray.
well, I don't know, cray, but it's very specific to the geography of
Right,
the points.
right.
You're not going to get 5 points in the Pacific Northwest typically,
Right.
but you might get 5 in Mississippi, Alabama, kind of those more tertiary markets.
That's right.
And it's more risk, and that's why you're going to get more.
And typically, the higher the price of the homes, the less the points are going to be.
Yeah.
You get down at where your average loan size is around $65,000, you're going to have a lot more points.
Well, yeah, you're going to have to, because you can't make. It's hard to make money at that
Right.
level.
That's what most hard money
there's a
hard
lot
money
more-
lenders make their money
There's a
on.
lot more competition in California, say, for loans than there is
Well,
in Mississippi.
the other thing I'm seeing too is that there's a lot of companies out there that have a minimum on how much you can borrow, and 75 seems to be pretty normal with a national lender. If the loan amount's less than 75,
And
a lot
honest-
of people don't want to touch it.
And 75 is actually pretty low for a national. I mean, I still see a lot at 100,000.
yeah.
There's a few that will dabble in the 55,000.
Yeah.
But yeah, I would say you're right. 75 to 100 is kind of
Yeah.
the low end.
And we're at 50. We're at
Yeah.
50,000. That's our minimum. And we'll do a loan for 30,000 for you. That's
We've-
fine.
We've done a loan for 30,000.
Yeah, but you're going to pay points on 50.
Yeah.
The interest will be based off of the true loan amount, but
Mhm.
you're going to pay points on 50 because there's a certain amount that
It's a break-even point for us to do this.
the loan in the
Yeah.
first place. Yeah.
Yeah.
Oh, and that reminds me, we have Eddie Speed coming on next
You
hour.
don't want to miss that.
And part of the takeaways that I've always had with seller financing is that most Fannie Freddie loans won't go below 75 to 65 range anyway. And it's not because they won't lend that low. It's just that there's a threshold to be a qualified mortgage. And if you charge the normal amount of fees that you have to charge on a conventional loan, and the loan amount is below a certain amount, then it kicks it into a high, what they call a high cost loan.
Mhm.
And now it's what they call non-QM or non-qualified loan.
Yeah.
Yep.
So there's a wide range of people that can do owner financing in that $65,000 to
range, yeah.
$75,000 range, and just can kill it.
Absolutely.
And it works out great for the borrower because they can't get financing anyway.
Yep.
And then
Mhm.
you're able to get passive returns without having to have responsibility for the property.
Right.
So
Right.
Yep. Nope.
Let's
all
look
good.
at this other question. We're already at 12:36. Let's see. Why do you charge an extension fee?
because we're greedy.
Well,
Well, first, let's talk about what an extension fee is.
yeah. Well, I guess my answer to why we charge an extension fee is like, why did it take you so long? Why did you not pay off?
That's right. Why do you need one?
No, but what is an extension fee? So short-term loans have a short term, which means they range from probably 3 months to 18 months is kind of a typical short-term loan, and oftentimes, especially on a fix and flip or even I guess even a bridge loan, you run up against your maturity date and you haven't quite exited the property, whether it was to sell it, to refinance it, whatever your course of action was.
We had a lot of buy and holds through the COVID that were ready to get their refinances done and didn't get them done, so they went past.
Oh yeah. So you go past your maturity date. So if you go past your maturity date, it is technically a default on the loan if you don't pay it off. So at that point, the lender can move to foreclose on the property. We don't like to foreclose. We will, but we don't like to.
It's not fun.
We would prefer to work with the borrowers, and that's why we are relationship lenders. We understand the needs. We understand, when you lose a GC on a project and you get a new one in, you're automatically going to be a month or two behind.
Right.
It's just going to happen. So now you've blown through your maturity date and you need an additional time to get the property where, to exit it, refinance or sell. So we do an extension fee for that. So what we're saying is we should have had that money back and we would have redeployed that money and we would have made money on redeploying it. Points on it. Origination fees. But if we're going to let you keep it, we still have to make something on it because we were going to make something on it if we got it back.
It hurts us when you're in the loan longer than you should be.
Yeah, exactly. So to keep our yield and our returns where they need to be, we have to make, sadly, we have to make money on the money we lend. So we charge an extension fee for that extra time that you need. And honestly, it's just because if we had the money back, we would be redeploying it and making money. And if we're not going to have that compensation, we have to be compensated in another way.
And keep in mind, you're getting a discount.
That's right.
We don't charge you the full origination fee.
You're
No.
getting a discount on your renewal because if we had that money back, we would have made more money on the redeployment. When you're doing 6-month loans, you're expected to take that same $100,000 and use it twice in a year.
Mm-hmm.
And if I can't use it twice in a year, then our yields actually decrease.
Right.
Because points, fees, interest rate, all figures into the yield.
Yep.
And again, we have a yield target that we're looking for our investors, and all that's figured into the equation.
Yeah.
Now, there are loans that are available for 12 months.
Sure.
But
we
those
don't
are
set
gonna
anyone
be-
up to fail.
Yeah.
We try our best not
if
to.
it's a
Yeah.
larger project, we know it's going to take longer. We're not putting you in a 6-month loan.
Yeah.
Like
but-
new construction, we do 12 months on
for
that.
sure. But if you have a $20,000 flip on your rehab, you don't need 12 months.
No,
if
you should be able to do that in a month.
I mean,
easy.
30 days you should have that done and listed. So it's based. The term of the loan is based on the needs of the loan product or the property.
Right. If
Yeah.
it's taking you longer than that, then you're not doing something right.
Yeah, and then
You need to be able
we're
to-
happy to introduce you to GCs that we know and other investors who can help you.
Yeah, and it's funny. So many people, when they're getting into a loan, they think that they're going to be able to get it done in a certain amount of time, and they want to save themselves money by doing the work themselves,
Oof,
or using cousin Tony to help them finish, or doing it on the weekends when they get an opportunity, or they're just not good at lighting a fire under their contractors or whoever they're hiring to bring in. They're choosing someone at a lower price and waiting until that person's ready to do it. That's the wrong way to do it, because If you think you're saving money, you're not, because the money you think you're saving, you're paying to us in interest.
Yeah.
Right. And renewal fees.
Yep.
On something like that. So,
and you've got to manage your general contractors. I mean, I had a conversation with one of mine just the other day, and we had a come to Jesus moment where it was just like, your inability to get this done costs me X amount every month. This is the money I lose every month. And you have to manage them that way. Because if you don't have those conversations, you're afraid to have those conversations, you're going to be, paying a lot of extension fees.
Yeah. You got to kiss a lot of frogs to get to the right guy, right?
Yeah.
And the other thing too is there are many people who will do a contract with the contractor, and they have a time frame in which they're going to finish the house. If you say, I can have this job done for you by July 15th, I'll come back as the owner and say, you know what, I'll give you until July 31st.
Yep.
But after July 31st, I'm going to start charging you $100 a day. I bet they'll finish it. And you can put that on paper. A lot of people do
Make
that.
sure you check those contracts for the amount of allotted rain days in there too.
Yeah.
So they like to throw in about 50 rain days.
Well, and then we did have, was it the beginning of the fall of last year where we had rain like every day, all day. It was like it didn't ever stop. For months we had a lot of rain. That was
we
awful.
had the Mold and Mildew Festival.
Yeah.
But if you'll look at all your municipalities and states, when they do contracts for roads and bridges and infrastructure, they all have the same type of contract. You get it finished earlier, we're going to give you a bonus.
Right.
You get it finished later, then it's costing you money.
That's right. And we like to have an extension fee. Ours is at 2%. Some people just have 1%. And some people, I love the folks that come back to us and say, well, I got it closed within 30 days of the extension. Do you have to charge me the whole fee? Well, yeah, we still didn't get to lend the money out. And we've negotiated on some in the past. And, there's always extenuating circumstances that go along with it. But understand that if you're going to be a lender, then you need to act like you're a real company and treat it like a real business and know that you have real costs. That's why being a lender is the best seat at the table.
Oh, yeah.
Because the things that go wrong aren't your problem, and they shouldn't be your problem. The risk is truly on the borrower.
For sure.
The borrower is the one that's they're making the biggest amount of money off the deal to begin with. If they do the things that they should be doing.
They're supposed to be making the most money.
That's right. So they should take on the biggest risk.
I love, I won't say who the quote is, but we all know him. His quote was when borrowers don't want to pay an extension fee or whatever it is, it's like, so I'm sorry, you're saying that money in your pocket's more important than money in my pocket, even though that this was part of the contract that we signed.
That's right.
You want me to, go back on the contract and adjust it, even though you signed it. So it's more important for you to have money than for me.
That's right.
Now,
the answer is yes.
Well, yeah. I mean, money in your pocket's always more important than someone else's.
That's right.
I don't know if it's more important or not, but it feels a lot better.
Yeah. It sure does.
And oh, by the way, Jonathan, I used to like your wife until I just saw what she wrote up in there.
I like what she wrote.
That's when you were,
old in your eyes. I didn't see it at the time.
That's because
you're so mean.
That's because you have old in your eyes.
Thank you, Sarah.
That's too funny.
So, do we have no one else has a question?
Are you tired? He's old and tired. He's old and tired.
We do have a really serious question. What is a water bottle?
That says that
is a water bottle. See, he has old vision.
The old in his eyes is getting in the way.
It has nothing to do with that. I just can't read.
Oh, that's too funny.
Oh, it's good.
What's really funny is watching you drink out of that gargantuan thing.
Correct. This is quite a water bottle.
That's for sure.
But, to go back to the extension fee, you can avoid a extension fee in a couple ways. Do your project on time and get it sold. Or, and we're pretty flexible. I mean, we get to, mull things around here and make decisions. And if you want to bring a principal payment down and reduce our level of risk.
Mm-hmm.
If you want to bring 10 to 20% of the principal payment down, we'll waive the extension fee. But you have to so from the lender's perspective, there's a perceived risk. So I know the term of the loan. I know I can quantify the risk based off of the property and the term. Now, if we go outside that becomes a higher risk.
Mm-hmm.
Because I didn't make this loan outside of this time frame. I made it for this specific time frame on this property. So you can either pay down principal to reduce the lender's risk, or you can pay a fee to compensate the lender for the risk.
Right.
There's two ways to look at it.
Right. If you are a lender, whether you're a private money lender or you're just lending out your self-directed IRA, you should be charging an extension fee to whoever you're lending to. I mean, I can tell you that for us, we've got people that have been in loans since 2018.
Yep.
And they're paying extension fees every 3 months. Every 3 months, they're paying on time. They're paying extension fees.
Yep.
And we would rather have those loans paid off.
Yeah.
We really would.
Oh, yeah.
Because we would make more money if they were paid off. But I mean, we've got we've had people that paid over $100,000 in extension fees. That's a lot of money.
Yeah, and the good news is it was during a time when values were increasing, so it didn't hurt them as much, but it sure cost them profit.
Oh yeah.
I don't want to
In
pay
a big way.
$100,000 in extension fees ever.
Yeah, it's kind of crazy,
But yeah,
but if you're a lender, you really need to consider doing that in a
Mhm.
big way. It says, what is the criteria for obtaining a loan?
well, there's a
First, Denise, you have to have a huge water bottle to bring to the table.
yeah.
No,
Well-
that's pretty easy, and it's pretty common for most people. It's different. It is a little bit different for every lender, but
Mhm.
but if you really want to get a loan, the first thing is most lenders are not asset-based lenders. And what that means is most lenders are lending not only based on your property, but they're lending it based on your ability to pay it back. Most lenders care about what your credit score is. We are at 650.
Yeah.
And that's actually probably one of the lower ends that we've seen.
Everywhere else is 680 plus that I've seen.
Yeah.
Yeah.
So, and you've got to have money in the bank. You're going to, she says she's going to
I
bring
can
a water bottle. So, you have to have some money in the bank. And when people ask me how much money, so
Depends on your project.
yeah, it
Yeah.
absolutely does. And I know when I'm talking to people, I tell them that rule of thumb, you can count on bringing about 7% of the total loan amount to the table in closing costs. That for us, that includes our fees, your insurance, your hazard insurance, your title insurance, title binder, attorney fees, recording, doc prep, all the things that you're going to see on a HUD.
Plus the 10% of the purchase price.
In addition to that, you're going to bring 10% of the purchase price to the table. That's for us.
Mhm.
Now, other lenders are going to ask for different things. Some of them are going to ask to see 20% of the purchase price, or they
Yep.
might want to see 10% of the purchase and the rehab together,
Yeah.
in addition to the closing costs.
Yeah.
And then you'll have lenders out there that won't have you bring any money to the table.
Yeah.
Good luck in finding them.
Yeah,
Yeah.
I'd like to find them for myself.
they're few and far between
Yeah.
now.
I mean, yeah.
Yeah.
And you can, more of the private money or people with self-directed IRAs or cash who lend on, just as a hobby pastime. Those are the people that are probably going to lend 100%.
Yeah.
Where you don't have to bring anything down, but the closing costs. But yeah, any company that's doing this is probably going to have you bring money down.
Yeah.
Now, what do you need to get a loan? A criteria, you need money. So you need to be able to bring the money down that's necessary. You need to be able to debt service the loan, which means pay your monthly payments.
Mhm.
So if you don't have that money in the account, there's lenders that will still lend to you as long as they see a cash flow on your bank statements that says you are making money. Like, you have a job somewhere that's paying you,
Right.
and you have the
So
cash flow.
self-employed doesn't matter. We just want to see that you
Yeah.
have some kind
Yeah.
of income.
And other than that, like
And that you pay your taxes.
Pay your pay your
taxes.
You don't have financial crimes or anything like that.
Yeah,
I mean,
we do pull a background check.
Yeah.
Not everybody does that, right?
Yeah, I mean, and as long as you're not like laundering money for the cartel, there's
Stop
other
doing
things.
that.
But yeah, stop doing that, please. But yeah, I mean, we look at all those different things, and so basically, you need a 650 credit score or higher. You need to not be a financial fraud.
Yeah.
You need cash to get started.
Yeah.
And you need to find a good property.
Yeah.
I mean, that's really it.
And we would like for you to have experience. Experience means at least having done one property. I mean, we like to see that experience. If you don't have experience, what we would at least want to see is that you're involved in real estate groups, like maybe your local real estate investor association, or you're coming to a subgroup. Like I have one, Sunrisers every Friday morning. We want to see, or that you were raised in a family of real estate investors. You can't help but gain experience from that.
Yeah.
So we want to know that you've done some investigating on what it is you need to do. Now, we hold your hand. That's one of the things that we do that's a little different than most any lender you'll work with, is we do hold your hand.
Yeah, we try. If you're a first-time flipper and you have all the answers and you're not willing to take criticisms or suggestions,
we won't get along.
Probably. I mean, probably not.
Don't call us.
Yeah, if you can't take suggestions from people who've been doing this stuff for 10, 20, 30 years, who will you take suggestions from?
Yeah, that's exactly right.
Yeah.
That's exactly right.
Well, I think this is the least amount I've spoken in a show since we've been doing this.
Congratulations, Bill.
We should start your own series. Well, I said that in one of the shows. It was the Stump Bill should be one of our things where people submit questions trying to stump Bill. I think that'll be a
Okay.
Poor guy.
That was fun.
You listen, we've got Eddie Speed on next. He's coming on at 1 and some minutes after that. 1:05. There's a separate link for that.
Yes.
I wonder, Scott, if it would be possible for you to put the link for the next one up on this video.
Or in the chat.
Not yet. Well, no, on the video, because not everybody will be able to see the chat. Scott, can you do that? Nod your head.
Oh yeah,
he's nodding his head. Yeah, so he'll put it on there. Great. So Eddie Speed. Oh, there you go. So that's the next one that we're going to be doing. Eddie Speed Note School. You don't want to miss this. It's so if you know about notes, you can do any real estate deal. You can make anything that works that comes across your desk work. It's excellent.
And this show, I saw this presentation that Eddie did a few weeks ago, and he's got some very timely statistics that have come up, and this is going to give people an opportunity to take advantage of what may be coming down the pike. And even if you're not taking advantage of it, at least you know what to expect.
That's right. And Scott also put them in the chat for us.
And we have one more question from Denise, and it already disappeared, but can you scroll back up, Bill?
Seems like I'm a little mouse.
What is the best way to learn about self-directed IRAs?
Oh, that's a great question.
Yep. Mm-hmm.
So you need to Google self-directed IRA companies, and I'll give you some names right now. First, go to Quest IRA.
Actually, it's Quest
Trust IRA.
Mm-hmm.
You'll also want to check out Camaplan, CAMA. Camaplan. You'll want to check out American IRA.
That's what I was going to say, American IRA.
Who's another one the Equity Trust Company as well. If you get on their websites, they have resources tabs where you can get online and go to their free seminars, free webinars. They're always training people on how to use your self-directed IRA. Yep. And if you know how to use a self-directed IRA, that's a great way to raise money for yourself.
And if you don't, we do.
Yeah, that's right.
Mm-hmm.
Hey, we raised over $30 million of other people's self-directed IRA money to lend from. So you can do that too. You got to
So,
know about IRAs. They're great.
There's another one called New View,
Yeah.
and
And
then
Rocket Dollar.
Rocket Dollar.
Yeah, Rocket
Mhm.
Dollar, that's a good one too. Yeah.
So they all of these companies have great education pieces on their website. They have webinars they do. They have virtual events that you can attend, and all of them are recorded.
And
well.
New View is NUVIEW, I think.
Yeah,
But
they
if
all
you just-
have their different things, and whether they all vary slightly in fees and things, and you have to figure out what's best for you.
Yeah.
You can get charged a yearly rate. You can get charged by the transactions that you do. So if you're a heavy investor and you want to do a lot of transactions, you're going to
Get
opt
the
for
yearly
get
rate.
the yearly rate.
Yeah.
And if you do 1 or 2 transactions a year, maybe do the transactional fees.
Yeah.
Mhm.
So, for example, if you're going to put your money into a couple of funds, that money's not ever coming out until you withdraw it. So you would definitely go by the transaction.
That's right.
If you're doing a lot of loans or buying properties and stuff, you definitely want to do the yearly.
And if you have money in a self-directed IRA, we can lend it out for you. You just let us know by going
Yeah.
to
The investor tab on carolinahardmoney.com.
That's right. Tell all your
That's
friends.
Now,
That's
you
right.
can also borrow money in the name of your IRA.
That is correct.
I don't suggest you do it on a fix and flip because your profit
2
would
minutes.
be subject to UBIT tax. If you're doing it on a buy and hold, at least you have depreciation that could offset
Right.
that.
Right.
So don't forget to share, like, subscribe, all that good stuff. If
Tell
you're
your
a
friends.
borrower interested in getting a loan, again, carolinahardmoney.com. Click on the borrower tab. Great questions today. Thank you guys for joining us.
Thanks so much. I hope
And
we
try
see
and-
you in
try
10
and,
minutes.
join the next show. All right.
Thank you.
Take care.
Awesome.